Yo, yo, how are you, sir?
Doing very good, bro. How are you?
Doing well, doing well. How's your week?
Good week, man. Good week, but I'm excited to get into what we got to talk about today, man. Get back to, blessing the people with some great information that's going to help them along their journey to creating that wealth, not just for themselves, but their family and the generations to come.
Absolutely, man. That's what it's about, man. We just come here every single week, really just for them. You know what I mean? So, as always, do your research, of course. You know what I mean? Kind of what we're here sharing is one of our own opinion. You know what I mean? And two, our best professional opinion, of course. But do your due diligence, right? So we always advise you take the extra time. Do your research, do your due diligence, such that as you continue to go out there and make a difference in your life, you're just empowered by those decisions, because that's kind of where we're coming from, to kind of just leave and impart something upon you guys, right? To again create that generational wealth, man. So it
That's
really is
it.
an honor. It really is an honor to be with you guys, and again, you Tristan, like it's something, man.
You as well, Marcus. I appreciate, taking the time to, you know, get together and expound on these subjects and talk about these matters. And I feel like just from us having these conversations as well, it's gonna allow us not only to educate, but also to be educated as well, because I
Absolutely.
feel like, as you said, importance of people doing their own research or making sure that they're consulting with their, whether that's their accountant or their lawyer about their particular situation. Like, everyone has a different kind of path that they got to follow and choose what's best for them. But we're going to come from our perspective, and I think I'm excited to hear not only what I'm going to say and bring to the table about some of these topics, but also what you're going to share as well. So let's get into it, man. Like, what we talking about today, Marcus? What's been on your mind lately? We already gave the people the brief intro about the wealth creation, right? So we set it off with setting the foundation, the one with the easiest, lowest barrier to entry, so to speak.
Mhm.
The one that really definitely sets yourself up for the next generation to come first and foremost, putting your family before yourself, because the wealth created through this strategy isn't really just for your benefit. It's for, like we said, the next generation. So that was the insurance, right?
100%. That was it. You know what I mean? Starting with life insurance as the foundation, right, to kind of set you up, because building wealth is one thing, right? So it's one thing to have wealth accumulation, and then almost like just risk mitigation, right? So insurance really is at the foundation of that, right? Ensuring that your assets are also protected as you're building your wealth. Because what's the point of building the wealth if it's just gonna kind of go off into the ether, so to speak, right? You want to make sure that's protected and mitigated as much as possible. And then after that, we kind of dove into one thing that's been known for years. You know what I mean? That really speaks to longevity, right? And that really is real estate. You know what I mean?
That's
Land has
it.
always been there. Land is going to be there in the future, and it's here now, right? And you always said in the last segment, just buy now. You know what I mean? Because it will always appreciate in value, right? So when you think about longevity, when you think about generational wealth, why would you not want to enter the real estate market? You know what I mean? So I don't know if there's anything you want to kind of touch on and add there. By
God
all
ain't
means.
making no more land. Like I told you guys last episode when we talked about real estate, I told y'all God ain't making no more land. So get yourself your slice, get yourself your piece. If you're in a citizen, it's kind of your right, to have your piece of the property, your piece of the land, your territory that you own and you control. And so that's very fundamental in terms of building off of that foundation of having the insurance in place, you know. But there's also a few other ways that are very common that we notice when we're studying wealthy people that we can now implement into our own lives to create wealth for ourselves. And that would be like owning a business, whether directly, through entrepreneurship, or what we're going to touch on today, which is investing in other businesses. Um, More specifically, publicly traded companies, so companies that you can buy on the stock market, so investing into stocks and benefiting from love proven businesses and proven entrepreneurs that are looking to raise capital by selling shares or pieces of their company on the stock market. So I guess we should start pretty much simple and plain. Like, what do you think so far, Marcus? You think like stocks is do people really create wealth through stocks?
100%. And you know what? And again, full transparency. You know what I mean? Like I knew very little of this world. You know, especially when I got into the industry of financial planning and insurance. That was the only area that I focused on. Like, let me just focus on insurance. Life insurance, right? At its core, right? And then after that, I started to learn about different insurance products. And then they always said, Marcus, do you do any, investing or mutual funds or any of that type of style of stocks and stuff? And I never really dove too much into it. I'm like, you know what I mean? Like, it was there, but it wasn't like something that I'd put my energy and focus towards. And now don't worry about that. Let me just do the insurance practice. But after understanding and studying more the affluent peoples and what they're doing, you know what I mean? Kind of taking in, Warren Buffett and, reading Money Master the Game by Tony Robbins, I start to understand that, oh my goodness, this world of investing, wealth is really accumulated through there,
Mhm.
right? And that's when I start to, slowly kind of dissect, you know, what is a mutual fund? You know what I mean? What is an ETF, right? And what's a self-directed trading account and versus a non-self-directed trading account? And that's why I started to understand, like, okay, like there's a big world here, and I could totally get how confusing and how complicated it can be to the new person. Again, hence why it probably took me a while to get into it. But there really can be, and not even really can be, wealth really is accumulated through the purchase, of stocks, right? Like 100%. As you mentioned, buying, publicly traded companies of other successful business owners, what I mean? Why wouldn't you? Where you could actually participate in whatever dividends or returns they have, or participate in, the growth of their company,
Mhm.
right? To, kind of not just create your own, I guess, wealth, but you could also transfer that as well, later on. And we kind of get deep into that conversation a bit later. But to answer your question, concisely, yes, wealth can be created by purchasing, stocks and investing of that nature. 100%.
Okay, because when I was asking that question, initially I was thinking of reasons maybe why it can't, but
Mm,
then right away you just said a name that I think we got to bring up again because a lot of people might have missed that, or if you're not familiar, it might have not resonated with you. And that was when Marcus said Warren Buffett. And it's very interesting because um, I was doing some upgrades in a class like when I was younger to try to get into university, right? So I had to do like some extra classes because, the first time around my marks wasn't where they needed to be. So at this place, they every day they had a delivery of the newspaper. So every day at lunch, I'd be reading the newspaper, checking it out, and I seen Warren Buffett surpasses Bill Gates as the world's richest man.
mm.
I'm like, Warren Buffett? I'm like, who's that?
Right?
I'm like,
If,
I
if,
know
if,
Bill
if, if
Gates.
you're,
I know Bill
that's it,
Gates got
right?
that bread, but
If
Warren
you're
Buffett
passing Bill
passed him?
Gates, exactly, right? You cause some alarms there. Go ahead.
Right. So then from there, that's when the first time Warren's name came across my radar. And I just looked more into it and got very, I don't want to say interested, but kind of obsessed about like, what? This man didn't start off as a thousandaire even. And like from a young age, he started finding ways to make money. And then he took that money and started investing that money. And what? Then he was so good, other people gave him money to invest. And then from there, like how he just took it step by step, to build up and then to become the richest man at the time, like that was just so mind blowing to me
Mm,
because it's like Bill Gates, it's like, yeah, okay, Bill Gates is a genius. Like this man
exactly.
was on the computers building like technology and software. Like, of course, he's a billionaire, but this guy I never heard of just surpassed him. And then that's when I really got, into in tune with the power of investing and how that compound interest that you gain over time and combined with the dividends, like how it just snowballs and creates that snowball effect where it grows and grows to where Warren Buffett can just over time of doing, the solid investing principles accumulate tremendous amount of wealth.
Mm. So good. And the few things that you said in there are so important, you know what I mean? And it's it really is a concept of saving. You know what I mean? Many people save money, right? And many don't. Let's just be honest, or as color as it is. But it's one thing to save money, then it's where are you saving it, right? You know, some may save it under their pillow, under their mattress. You know, that's what our parents used to do. And you got to also factor in, you know, this thing called inflation in the world, right? You know, over here, Canada grows at about, you know, out maybe on average of like 3%. So if you have your money not actively growing or not actively working for you, right, then by virtue, by default, you're always staying behind that eight ball, so to speak, right? You have the cost of living increasing quicker than, you know, the money that you're quote unquote saving. And this is why it's important to kind of put your money into the market or invest, you know, into, you know, stocks and other companies such that you can really participate in their returns, right? So that it can at least bare minimum keep up with inflation. Although the goal would be to have it, you know, surpass the rate of inflation. This way your money is actually working for you and growing quicker than, you know, the cost of living really is.
Mm, word up. That's an important thing to that you touched on, you know, because a lot of people don't really take that into consideration. And if you're keeping that $2,000 in your mattress or in a low interest bank account, you're actually losing money over time. That
Mm-hmm.
money's decreasing in, I guess, spending power day by day, right?
That's it.
So what you said is it makes sense because if you take that idea of putting your savings into your investments, it's like much beneficial, more beneficial than just having it sitting there going down in value.
Exactly. Right. And where do I want to go with this? I had a few thoughts in my mind, and I guess I'll quickly touch on, you know, different styles of investing, right? Because everyone will have their own different unique styles. You know what I mean? And I want to try and create analogies as maybe as simple as possible, right? And you know, one style is the self-directed, right? That many people may be kind of familiar with. You know what I mean? I want to, you know, put my money into Tesla, or I want to buy Google shares, or Apple shares, and a great way to invest, 100%, right? Again, and that takes a lot more research, right? Meaning, you got to find out, you know, how the company is performing. You know what I mean? Like, do you see longevity in the company? You know, are you backed by, you know, the owners and the founders, and right? And that's the additional research required, right? Where you could actually start buying these individual companies
Mm,
and participating in their returns, right? So with that style of approach, you know, again, you have the potential for, you know, high gains and, you know, high losses given if they don't do well. Okay. Um, and right, as long as you have, I guess, the capital to kind of invest in that type of style, 100%. And I say that type of style because some companies are valued a lot more than others, right? Now, if you're not willing to do that type of research to find out, you know what I mean, like, you know, how good one is or da da da, that's when you can kind of do the whole mutual fund style of investing, right? And you're really just spreading your risk. It's really just diversifying, okay? And what the mutual fund style of investing is, it's like buying a group of companies ultimately, right? You put, you know, $100 in, so to speak, and instead of buying, you know, one share of Apple, hypothetically, you now are spreading your $100 to buy, you know, a few shares of Apple, a few shares of McDonald's, a few shares of, um, I don't know, Coke, right? You're really spreading and diversifying your $100 or your capital. And the benefit of that is that if a few companies aren't doing so well, it mitigates your losses, right? Now your gains may not be as much, but it mitigates your losses. And Warren Buffett, you know, he's got two rules. His first rule of investing is you don't
don't
lose
lose
money,
money.
right? And his second rule, don't forget
Don't
rule
forget
number
rule one.
one. Right? So it all depends on what type of investment style you like to do, right? But I guess very high level, those are the two different types. You know, the mutual fund style, where you're spreading and diversifying your capital, so to speak. And then there's the self-directed. So you just go out there, just really just buying all the individual companies that you kind of, love, trust, and respect, so to speak.
Hmm. And I think something important to bring up as well, I know you mentioned like some of the benefits. I think it's also important to, consider some of the possible cons that can go with looking to go that route, or even going the self-directed route, that people should keep in mind and consider and look out for as well. And some of those things, like from my own personal experience as well, is like some of these mutual funds, it's like a lot of times your gains kind of get cut out by these extra fees. So sometimes a fund manager of a particular fund, they'll charge a management fee on the percentage of the funds that they're trading or whatever. Or when you sometimes another example, like with the self-directed route, is there's different kind of companies that you can um, use to have your brokerage account, right? But
Mm-hmm.
something you got to take into consideration is the fees. So for example, if you're at a bank and if they're charging $8 American per trade and you're buying one stock at a time, that might not be the best fit for you. If you're American, that maybe it would be more cost effective to use a Robinhood. And if you're Canadian, maybe it would be more cost effective to use the Wealth Simple. But it really depends on, your particular situation and just weighing the pros and cons for what you're trying to do. But I think something important that I definitely want to bring to the table or to the forefront, and share with the people is another great man that everyone should, you know, um, maybe research or learn from, and it's a man named Michael Lee Chin.
Mm.
Now, Michael Lee Chin is a Jamaican who came to Canada to study, and now he's Canadian and Jamaican also, but he's also a billionaire, and he's a Canadian billionaire, and he's black, and he's Jamaican, and like and something that was very interesting to me, like when I was researching about Michael Lee Chin, is is he really studied Warren Buffett.
Mm.
And he was studying like how is wealth created. And then he's like, oh, okay, the stock market. A lot of these guys are, okay, how is wealth created in the stock market? And he just kept reading books and reading about this rich guy and that rich guy. But when he came across Warren Buffett, he's like, oh, a lot of his principles make sense. And then he was like, okay, there's like five principles or overarching columns, he said, or principles that are used to create wealth in the stock market.
Mm-hmm.
And he's like, I don't know if I remember all of them, but he's like, you want to get a good company with solid management.
Mm.
If you can, you want to get it at an affordable price. He's like, you want to thoroughly understand all the businesses that you're invested in. You need to make sure that all the businesses are in long-term growth industries. And I'll remember the last one. But
Warren
yeah,
Buffett is powerful too. Continue.
yeah, that's what he was saying. So it's like, oh, you only want to own a handful, because he was saying something that didn't make sense. And actually, this is what kind of helped him to create wealth in the stock market. He created his own mutual fund, because what he discovered when he was looking at the mutual fund market, he was working at I don't want to shout this company out, but he was working with an investment company here and in Canada when he got out of school, and he was trying to sell investments and selling mutual funds and different kinds of things like that. But as he was selling it to his clients and looking more into it, he's realizing a lot of things that these funds were doing were contradictory to the principles that he learned when he was studying Warren Buffett and those guys. And he's like, a lot of times these mutual funds they have 100 companies, 120 companies in one fund or something like that. And he's like, how can a reasonable manager thoroughly understand 100 different companies at one time? And he's like, Warren Buffett's not buying every single company. He's buying a select few companies that he see are, like where he believes in the management and they have that long-term growth industries, like things like that. So it's like, he just took those principles and brought them into the mutual fund market, where maybe there'd be 12 different companies in one fund, or
Hmm.
you know, something like that. And that's kind of how he was able to differentiate himself in that market and create his wealth, and eventually end up selling to Manulife, you know, for like billions of dollars.
Powerful, yo. And it's still true because, a lot of mutual funds, they are set up that way, right? Like even if you look at the prospectus of a mutual fund, they'll kind of show you, or the fun fact, they'll show you like the top 10 holdings. And if you add up all the top 10 holdings, it doesn't equal, to 100% of the mutual fund. So it's like, well, where else is the money invested in, right?
Mm,
And that's why where it's invested into, different other, sectors or companies. So it really speaks to that, right? So you could truthfully, and again, you could truthfully build your own mutual fund. Like you don't quote unquote need a fund manager to do that. You could build one on your own.
right. And you know what? I think that's powerful you said that, because in reality, it's like, this is your money. Like, this is something you should be learning about, thinking about. You should be in the world seeing these companies affect and thinking about, you know, which ones in the future are going to be powerful, or who's doing what right, or what, Facebook just bought Instagram. Man, everyone's on Facebook or Insta. Like, you should be looking and thinking, oh, everyone's buying Peloton. Man, oh, everyone's on Zoom now. Let me look up this Zoom company price. Oh, let me see who's the CEO. Let me Google his name,
Hmm.
see, you know? And it's like, it don't take much time. And the amount of time people are spending, you know, doing things that aren't beneficial, is like, you can take the time to learn how to invest in the stock market and see the effects and see if it works for you, you know?
For sure. And what I will say for anyone listening is kind of like, well, you know, I've seen the price of Zoom. I ain't got like $300 to buy, one share at a time. You know what I mean? Like you could always start off again. You could, if you desire to build a mutual fund on your own, you could start off that route. You know what I mean? Because you still want your money to kind of work with you and grow. You know what I mean? Like it's one thing to, kind of save and put away, a couple $100 a month, as opposed to putting that in a mutual fund, actually getting some gains to build up some of that capital, so then you can kind of play that game individually. You know what I mean? So like, I guess I'm
You
saying this
make
because I
your
don't want to.
savings systematic.
Yes, exactly, right. Dollar cost averaging, but I don't want to like. Because again, I'm speaking from experience too. You know what I mean? Like I hear someone saying something to me, and I can be totally checked out because I may not be in that lane,
Mm,
right? And then it's like, what? There's also a lane for you, and this is the lane that you may need to get, or where you may need to start to get into this lane. You know what I mean? Because I'd hate for someone to kind of see like, oh, that's where I gotta be, and for me to get there, it's gonna good luck. I can't get there. It's like, well, no, there's you could start, here at A, and kind of slowly work your way up so you can play in this arena. You know what I mean?
right.
Right. So I think I just wanted to kind of underline or preface that in case there are people listening and be like, well, how do I get there if I only got X? Well, you start small. You start with what you got. Kind of build up your saving. Start that systematic saving, the whole dollar cost averaging, and kind of work your way up. Right. So I think I just wanted to kind of underline and preface that because everything you said it really is gold, and it really is the truth. You know what I mean? Everything that Michael Lee Chin said, all the concepts that Warren Buffett applies, and the truth of what mutual fund is, and fees that we spoke about, because you got to be responsible for those too when you are investing. What are the fees associated with your investment, right? Whether it be management fees or trading fees, like these are all things that you have to factor in when it comes to accumulating, building these wealth, right? And then on the back end, you just want to make sure, because some of you guys may be listening, sure, I get it, fine, that's one way for me to build capital and build wealth, but is this a way of transferring it? Yes. The transfer aspect of it now is ensuring it's set up and structured properly, right?
Mm,
Such that, you know what I mean, depending on type of account, you have the right beneficiaries on it. So you kind of transfer or move over that, that book of business, or the wealth you've accumulated, right? Or setting up trust funds. You know what I mean? Like there's ways in which you can kind of structure it, because this is where the gold is. It's structuring these accounts or these funds such that, when you do become an angel, right, it's properly, effectively, and efficiently passed down to your ears or your beneficiaries.
mm,
One, doing your best to mitigate tax, right, as much as you can, really, but such that is passed down, and these are things which you can kind of pass down, right? If structured properly.
Yeah, for real. Because it's very interesting that you said that because um like we have a group, like a group chat, and when we first brought up like this idea of how it's well created and um the different routes, and we went more into stocks, like that's when I was like, shit, like I've been bullshitting, I ain't got no stocks, like I need to get some stocks. But then I was thinking about it and I was like, man, any extra money I get, I'm gonna put it back into my business or into acquiring real estate.
Mm.
But then I was looking at the chart. Like there was a chart that my cousin was talking about in the group chat. Like he brought up a term, that dollar cost averaging, and like
Yep.
I Googled it and I looked more, and there was a bunch of charts that came up and it shows like how value grows over time. And I was like 60, like by then I'd already be old. But I was like, well, by then if my daughter's 30, she got millions in the stocks. I was like, okay, like maybe it does make sense I invest now, but not for me, because there's no point me saving money for my daughter. Let me take that money I setting aside for her in savings and let me put that in the market. So when she's older and she'll have the stocks. So that's like what made me like start to now, okay, how do I have this self-directed? Let me go into the bank. Let me make sure. Well, okay, what comes with it? Well, simple. Let me read the contract. Let me check this out. What's the details? So that's when I really started to really, actually start to take action on what I learned from reading Warren Buffett when I was 19. It's like, so that would be my biggest thing, is this, like, especially you younger people, like if you're hearing this, like don't sleep on this information, because the earlier you act and invest and get in the market, the better. And I was telling these kids, I coach these 10-year-old kids, and I was like, man, if your parents bought you 1,000 of stock in Apple when you were born, it'd be worth over 10,000 now. And they were like, what? And I was like, yeah, that's why you gotta invest in stocks. So I'm like trying to tell them to like put it in their head, but I'm like, yo, for you people listening too, like don't just sleep on this information. And then after you look up dollar cost averaging or look up a compounding penny. So you want to touch on that, Marcus? You know about the compounding penny, no?
Yeah. So yeah, the compounding
Yeah,
penny,
share
dollar
that with the
cost
people,
averaging.
please.
So yeah, so those powerful things. So I guess the what it comes down to is, which would you rather have? Would you rather have, $1 million today, right? Or would you rather have one penny? So think of a 30-day time span, okay? 30 days or 31, tied up to you. But you could have $1 million day one, or at the end of day 30 or day 31, you could have like one penny doubled every single day for 30 days or 31 days. So, day one, you have one penny. Day two, you have, one penny plus like two pennies, so compound interest. Day three, you get, you're doubling that 2 pennies. Now it's 4 pennies, right? So you just keep doubling that. Um, what the math works out to, I think by day 30, that penny doubled every single day for 30 days is, well, almost like 1.3 million or something to that effect, right? So that's just the power of compound interest, right? And then with dollar cost averaging,
Hold on,
right?
before you touch on that, he
Go
said
ahead.
something important and powerful. That's compound interest, compound interest. So I ain't no genius, but someone who is widely regarded as a genius, as like, one of the greatest minds of our modern civilization, is Albert Einstein.
That's
And
it.
Albert Einstein's quoted as saying that compound interest is the eighth wonder of the world.
Mm.
So he recognized the value of compound interest, how it could just make money or just make numbers double up or quadruple up or just build up quick. So just saving that money over time, it's going down, but you invest, you're going to benefit off that compound interest, especially over the longer the term, the more it compounds. So the more that it grows.